Today, I want to reframe one of the most misunderstood parts of personal finance. An emergency fund is not a low return investment. It is not designed to beat inflation, compete with stocks, or become the most efficient asset in your portfolio. Its real job is to protect your decision power. When income stops, when a medical bill appears, when a car or home repair cannot wait, or when markets are falling at the same time that your life needs cash, this money prevents you from being forced into the worst possible decision. It helps you avoid selling long-term investments at a bad time, borrowing at expensive rates, canceling necessary protection, or making emotional choices because you have no room to breathe. This is educational content, not investment advice. The point is not that everyone needs the same number of months in cash. The point is to understand what the cash is protecting. The first distinction is that emergency money and investment money have different jobs. Investment capital is judged by long-term purchasing power, expected return, diversification, taxes, fees, and risk. Emergency money is judged by liquidity, stability, and certainty of access. If you use volatile assets as your emergency fund, the account may look more efficient on a spreadsheet, but the real test comes when you need the money. Markets do not promise to be high when your life becomes expensive. If your emergency fund is invested in risky assets, you may be forced to sell the same assets that were supposed to compound for 10 or 20 years. At that moment, you are not just selling at a price. You are interrupting a plan. The second idea is that the absence of an emergency fund turns small problems into chains of problems. Imagine losing your income for 3 months. Rent, mortgage payments, insurance premiums, utilities, groceries, and family responsibilities do not pause because you feel stressed. Without a buffer, you may first use a credit card, then take a personal loan, then stop your automatic investment plan, then sell investments during a market decline. Each step may look like a short-term solution, but together they can transform one income shock into debt stress, investment interruption, and emotional decision-making. The emergency fund breaks that chain. It buys time to search for work, cut spending carefully, negotiate with creditors, or reorganize family cash flow without destroying a long-term portfolio. The third idea is that an emergency fund should match your risk sources. It is not automatically 3 months for everyone, and it is not automatically 12 months for everyone. A person with stable income, no dependents, flexible rent, and strong insurance may need a different buffer from a freelancer. A single-income household, a parent with children, or someone with a large mortgage. The better question is this: if income stopped for 6 months, what goal would be sacrificed first? Would you sell investments, borrow at a high rate, cancel necessary insurance, or miss payments? If the answer is yes, the emergency fund has not finished its job. The fourth idea is that emergency cash can be layered. The first layer is immediate spending money, usually held in a bank account that can be accessed quickly. This handles the first month or two of unexpected expenses. The second layer is short-term stability, held in safe and predictable instruments that can support several months of living costs. The third layer, if needed, is a wider margin for people with unstable income, family obligations, or business risk. The goal of each layer is not the highest yield. The goal is to make sure money is available when it is needed, without a large loss, without complicated steps, and without a delay that turns the emergency into a bigger problem. The fifth idea is that cash changes investment behavior. Many investors think they have high risk tolerance because they can answer a questionnaire calmly. But a questionnaire does not recreate the feeling of a market decline, combined with a job loss, a medical problem, or a family expense. When life risk and market risk arrive together, rational plans become harder to follow. Emergency savings separate those two risks. In that sense, cash may lower the return of one account, but it can raise the chance that the entire investment plan survives. The sixth idea is that the fund needs maintenance. It is not a number you set once and forget forever. Review it when rent changes, when mortgage payments change, when children or parents become part of your financial responsibility. when insurance deductibles change, or when your job becomes more or less stable. Review it after major life events, marriage, a new child, a move, a career change, a business launch, or a new debt. A 3-year-old emergency fund target may no longer match your current life. You do not need to check it every day, but you should not treat an old number as permanently correct. The seventh idea is that emergency savings should be evaluated alongside insurance and debt. Insurance handles low probability, high loss events. Emergency cash handles ordinary but unpredictable cash flow gaps. They are not substitutes. If you have no basic insurance, one major event can consume the entire fund. If you have insurance but no cash, you may still struggle while waiting for reimbursement or paying deductibles. Debt matters too. High interest debt makes emergencies more expensive, and floating rate debt makes monthly cash flow less predictable. If your household has debt obligations, minimum payments should be included in the emergency fund calculation because those payments continue even when income is interrupted. The eighth idea is not to cancel cash because of inflation anxiety. It is true that cash loses purchasing power over time, but the cost of having no cash can also be large. Forced selling, missed payments, high interest borrowing, or the interruption of a long-term strategy. A more useful approach is to give money different jobs. Money needed in the short term protects life stability. Money not needed for many years pursues growth. You do not need every dollar to do every job at once. Cash is not supposed to be the best growth asset. It is supposed to protect the growth assets when life becomes unstable. The ninth idea is to keep the emergency fund separate from daily spending. If all money sits in one account, you may think you have a large cushion, even when much of that balance is already assigned to rent, annual insurance, taxes, travel, tuition, or other planned expenses. Mixing accounts creates two mistakes. First, you overestimate your real safety margin. Second, you invest money that will be needed soon, then sell assets when the planned bill arrives. A separate account and a clear name reduce accidental use. Naming the fund is not cosmetic. It protects the purpose of the money. The 10th idea is to build the fund in stages. You do not have to complete the full target immediately. Start with 1 month of necessary expenses, so a repair, medical deductible, or short gap between jobs does not become revolving credit card debt. Then move toward 3 months. After that, adjust towards 6 months or more based on income stability, family responsibility, insurance gaps, and debt pressure. Investing can continue at a smaller level during the build-up, but do not invest so aggressively that the safety cushion disappears. Here is the closing test. Do not ask only, is this cash earning too little? Ask, if I did not have this cash, what would I be forced to do during a bad moment? If the answer is selling long-term assets, borrowing at high rates, canceling necessary protection, or making panic decisions, then the fund is not idle money. It is an asset that protects your choices. Protect decision power first, then pursue higher returns. Let short-term cash prevent life emergencies from breaking the long-term portfolio. That is the real role of an emergency fund in a financial system. A practical household example makes the point clearer. Suppose a household earns $8,000 a month and normally spends $5,000. On paper, the $3,000 surplus looks available for investing. But if the household has no emergency fund and income stops for 2 months, the investment account becomes the emergency account. If markets are down, selling means locking in losses. If the household refuses to sell, it may borrow at a high interest rate and create a new monthly payment. The proper comparison is not cash yield versus stock return. The proper comparison is cash yield versus the cost of forced selling, expensive debt, and broken planning. There is also a psychological cost. When next month's rent, insurance, groceries, and medical deductible are already covered, a market decline looks like an investment event. When cash only covers 2 weeks, the same market decline feels like a survival threat. This difference is not simply about discipline, it is about financial structure. Many people do not abandon long-term plans because they lack knowledge. They abandon them because life cash flow removes the option to be long-term. Emergency savings give the long-term plan enough oxygen to remain long-term. To size the fund, start with necessary expenses rather than lifestyle wishes. Necessary expenses include housing, basic food, transportation, insurance premiums, minimum debt payments, essential family care, medical deductibles, and tools required to keep earning income. Travel, upgrades, entertainment, and flexible spending can be cut from the emergency calculation. This does not mean life must be harsh. It means you know the minimum cost of keeping the household operating during a bad period. Once that baseline is clear, a target of 3, 6, or more months becomes a real planning number rather than a slogan. Then think about income recovery speed. Some workers can replace income in a month. Others need 6 months to find a comparable role, rebuild a client pipeline, or move into another industry. For freelancers and business owners, income may not fully stop, but it may become uneven. The slower and less predictable the recovery, the more the emergency fund acts like time insurance. It buys time to negotiate. Search carefully, choose clients, avoid desperate pricing, and protect career quality. In that sense, the fund protects career decisions as well as investment decisions. Some assets look valuable but are poor emergency tools. A home may have value, but it cannot be sold in 3 days at a fair price in small pieces. Stocks and funds are liquid, but their prices may be depressed exactly when cash is needed. Insurance policies, retirement accounts, and tax-advantaged accounts may have penalties, delays, or surrender costs. Net worth is not the same as usable cash. Emergency money should be held where it can actually be used under stress. Finally, create a refill rule. Using the fund during a real emergency is not a failure. That is the reason the fund exists. The mistake is using it and never rebuilding it. After the event, temporarily reduce optional spending, slow new investing, or direct bonuses and extra income back into the first cash layer until the target is restored. A written refill rule prevents the fund from quietly becoming a one-time cushion that disappears. Use this checklist. If income stopped for 3 to 6 months, could necessary expenses continue? If markets fell sharply while a large family bill arrived, could you avoid selling long-term assets? If insurance reimbursement took time, could you pay deductibles and keep the household stable? If you use the fund, do you have a refill rule? Is the money separate from daily spending, short-term goals, and investment capital? If several answers are no, the issue is not that you are being too conservative. The issue is that your decision power is underprotected.